Is the Tata AIA Param Raksha Life Pro plan your pathway to lifelong protection and wealth creation, or just another overhyped product available in the market? So let us find out the answer to this question through an in-depth analysis in this video. So hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. So before analyzing this policy, let us first understand a few basic details about it. So this policy is designed for a combination of benefits of one separate product's name, Tata AIA Smart Sampurna Raksha Supreme Plan, which is a unit-linked non-participating individual life insurance plan, and a combination of another product called Tata AIA Vitality Protect Advanced Plan. So this is a non-linked, non-participating individual health product. So we have already analyzed both these policies separately. So if you want to watch that, we have linked the video link in the description for your easy reference. Some of the key features of the policy are: there is a lump sum payout to the nominee in case of the policyholder's untimely death, and an additional sum assured is provided in the event of accidental death. So the benefits paid in case of total and permanent disability due to an accident, and also 10% of the sum assured is paid on diagnosis of a terminal illness. On maturity, the fund value is paid to the policyholder. So the upfront discount on the Vitality Protect Advance premium during the first policy year is also available. So these are some of the key features of the policy. So now, as we have a basic understanding about this policy, let us now move on to the analysis part of the video, where we are going to conduct an IRR analysis using the benefit illustration given in the policy brochure to help us understand and make a more informed decision. So here, for calculation purpose, we have assumed a 35-year-old male opts for this policy with a sum assured of 1 crore and an annual premium of 91,561 rupees, with a policy term of 50 years and a premium payment term of 15 years. So to illustrate two written scenarios, which is 4% per annum and an 8% per annum, where this policy is projecting worst and best case scenarios just for projection purpose. These are not guaranteed returns. The actual fund value will depend on market performance and fund management. So at the assumed 4% return as per the policy brochure, the maturity value is 11.17 lakhs, resulting in an IRR of 0.48% as per the policy's maturity calculator. So the investor receives less than the total premiums paid, a negative return. And at 8% projected return, the maturity value is 1.36 crore, translating to an IRR of 5.42% as per the policy's maturity calculator. So while this may appear reasonable, it's still lower than the returns offered by many debt instruments despite the equity market exposure. So the reason for the subpar returns lies in the bundling of features. A significant portion of the premium is allocated to life cover and health benefits, with only the remaining amount invested after deducting multiple charges. So the diluted investment component leads to a shortfall in wealth creation, potentially derailing your long-term financial goals. So in a nutshell, this policy may limit rather than enhance your financial outcomes. So as this policy is not giving us a desirable outcome, let us now look at smarter alternatives that may deliver far better outcomes using the same annual premium. So instead of locking it into a bundled product like this, let us split it smartly between pure life insurance for life cover purpose and other focused investments. For life cover, we have opted for a pure term life insurance policy with 1 crore cover, 30-year term and 15-year premium payment. So the annual premium is 25,200 rupees. After paying the pure term life insurance premium, you are left with 66,361 rupees to invest. A powerful sum that can work much harder for your future. So let us now take a look at the investment options you can potentially invest based on your risk appetite. So if you want a low risk option, you can opt for PPF, where you can invest 66,361 rupees annually in a public provident fund PPF over 50 years, where the maturity value you will get is 1.98 crores and the IRR will be 6.32%, which is completely tax free. So despite being a conservative option, it outperforms the returns of Tata AIA policy. So if you want a high risk option, you can opt for equity mutual fund. So if you invest in equity mutual fund for over 50 years, your maturity value will be 14.62 crores. So the post-tax corpus, which is after LTCG tax accounted at redemption, the post-tax corpus would be 12.81 crores. So the post-tax IRR is 10.87%. If you have any doubts regarding how we have calculated tax for equity mutual fund, you can see that we have presented a small tabular column for your easy reference in the screen. So this approach offers superior long-term growth and better liquidity. So more transparency in cost and returns, greater flexibility to change or stop investments, higher liquidity in case of emergencies, and better customization based on your risk profile. So bundle plans like Tata policy may seem convenient, but they offer limited returns. Instead, separating insurance and investment provides better control, flexibility, and significantly higher wealth creation potential. So what is the final verdict then? Is investing in this policy worth or not? So this is a bundle product combining life insurance, market linked investment, and a health benefit. While the concept may appear convenient, it often falls short in delivering value across any of these aspects. In practice, purchasing life cover and health insurance and investment separately is far more effective. It ensures that each need is met optimally with better coverage, flexibility, and returns. Though the plan positions itself as a long-term investment with maturity benefits at 75 or 85, the projected returns are disappointingly low. So despite the extended horizon, the market linked investment component fails to deliver competitive growth, leading to a potential shortfall in wealth accumulation. So adding to the concern in the lifelong cover, which drives up the premium. So in personal finance, life insurance is generally required only until retirement, not for life, making this feature misaligned with real needs, and it also has a high agent commission. As a result, the plan suffers from suboptimal returns, low liquidity, and costly and misaligned life cover. So rather than relying on bundle solutions, a smarter strategy is to choose a pure term insurance plan for low cost, adequate protection, and invest the surplus in well diversified instruments aligned with your risk profile and goals. So this method provides greater transparency, control, and higher long term returns.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.